All right, good day, everyone, and welcome to a very special edition of Rogue Money Radio. We're here on Sunday to deliver some great information. Our guest today absolutely needs no introduction at all. Today's guest is Jim Willie, editor of the Hat Trick Letter that you can find on goldenjackass.com. I'm very excited to have Jim with us today. Jim, how are you, sir?
Oh, I'm doing fine. We're in the it's hard to describe things sometimes. I think we're getting into the meat of a very serious global financial crisis. And, you can harken back to 2007 and 8, the subprime mortgage bond problem that erupted and resulted in the killing, not just the failure of Lehman, but the killing of Lehman. What happened was J.P. Morgan and Goldman Sachs conspired together to buy a few $1 billion worth of Lehman mortgage bonds, and they never paid for it. They suffocated him. It's like putting a bag over a guy's head with his hands tied. That's what they did to Lehman. So anyway, what we have now is the eruption of a problem that's now extending to sovereign debt. Sovereign bonds, like government bonds. That's what they mean by sovereign. Sovereign bonds are government bonds, official major nation government bonds, like the U.S. Treasuries. We're now seeing the results of not fixing the problem after Lehman. This is very, very serious. We really didn't fix anything. I have a phrase that I've been using for years now. Following the Lehman event, regardless of how they died, that's not important. Lehman was killed. Lehman died. That's the main thing. They're no longer, and the whole global financial crisis, it's even got an acronym, GFC, Global Financial Crisis, is the post-Lehman financial mess. We never really fixed anything. What we did was the major banks tied themselves together with derivatives. They actually have a strategy where they come out and say, we're going to protect ourselves, and we're going to they don't say lash, that's my term. They're going to protect themselves by making it so that the derivative responsibilities are all shared. There's no one or two banks that are going to sit with the risk. Okay? And as a result, the whole system becomes more at risk. We're moving toward a systemic Lehman event. And it means sovereign bonds are going to be a problem. We might see Italian government bonds go poof. We might see Saudi Arabian bonds go poof. And that's just the way it's going to turn out this time, because they didn't fix anything. The central bank balance sheets are even larger than before, like multiples higher, twice, three times higher. Euro Central Bank had nowhere near the size of the balance sheet they had now, back in 2008. You have entire banking systems that are teetering and had bank runs, like in Italy. You got numerous banks, like in France, that are in deep, deep trouble. And we didn't fix anything. We just threw more money at it and had the derivative responsibilities shared among many different major banks, and not just Morgan Stanley, which was the kind of the designated Wall Street bank for derivatives. And in Europe, the designated bank was Deutsche Bank. So here we are, and now a psychological effect has hit the wall, and that is people are beginning to believe some of these sovereign debts are never going to be repaid, and that could be one of the very big reasons why the 10-year Treasury yield is going up. CJ,
Right.
Unpayable debt. So
yeah, and it's truly amazing because when you look at the budget that was proposed, by the apparent conservatives in the House and the Senate, they don't care about debt anymore, Jim. It's just ridiculous right now, the amount of U.S. debt and global debt, and what exactly is going on with it right now.
Yeah, well, okay. Now, that's my introduction. We created a systemic layman problem. Who are the layman players who are at risk right now? I mean, before it was J.P. Morgan, Goldman Sachs, and Lehman, and a few others. So they decided to kill Lehman, get the TARP funds, steal it, devote it toward preferred stock for the big Wall Street banks, and never provide it as lending capital, which is what the Congress did. For what, $700 billion? I think it was $700 billion in the TARP fund. Okay, so they killed Lehman and described them as the problem child. No, they were all problem children. You go back to those days and you find that Goldman Sachs got repaid 100 cents on the dollar from AIG, which they also ransacked. So they killed AIG, ransacked it, paid off Goldman Sachs. Goldman Sachs continued to run the Department of Treasury, and they killed Lehman by suffocating him, not paying him for $2 or $3 billion in mortgage bonds. Okay, now the players at risk are government debt. The players at risk are entire national banking systems. The players at risk are economies that are stuck in recession. This is not going to be easily resolved. And the reason I'm here as an interview guest is to explain through a number of factors how this might get played out and how this might be justified by precisely the banking entities at the top of the food chain, who normally get in the way for solutions. Now they're not going to get in the way, they're going to be suggesting the solution. That's the big difference that I see in the near-term horizon and the mid-term horizon. Not long-term, not 3 to 5 years. That's more like long-term. Intermediate term is like a year and a half, maybe 2. Near term is the next several months. Okay, I'm thinking near term and short term, we're going to start seeing pieced together here, CJ, some solutions that come from the Uber bankers. I'm referring to the Bank for International Settlements in Basel, Switzerland, which I will refer to as BIS or just Basel. Basel, I mean, we have things like, okay, it's becoming part of the vernacular now in banking. You've got your Basel II rules. Like, for instance, you can't have bank funds used for certain investments. You have to have certain capital ratios maintained. That's Basel II. Okay, so Basel in Switzerland issues rules for the central banks. The pecking order is very clear. You're not hearing Bank of England is suggesting something. No, you're hearing Basel is making the rules. So when I hear about the Basel proposed solution in the face of a new international financial crisis, I think this is important.
Yeah, absolutely.
And that's what I have here today.
Yeah, and we're very thankful, Jim, that you're able to come on and share this very important information, because as we were talking before we went live, this is game changer.
This is not just game changer. This is an entire reform in line, and it qualifies as a reset. We've been talking about and being teased by the phrase of global financial reset. What I'm describing in this interview is potentially that exactly.
Well, let's go ahead and share. Let's jump into it in terms of, and I know that there was a gold chapter in your February hat trick letter for your subscribers that details out this proposal by the BIS. Could you walk us through that, please?
Okay. I gave a decent introduction to the problem. I call it I haven't heard anyone else call it this. I have a name. I call it the systemic Lehman event. And what qualifies as that? Well, entire economies, entire banking systems, and major sovereign bonds, major sovereign nation debt securities. For instance, Euro bonds, Italian government debt, UK gilts, and US Treasury bonds. They're at risk. They're at risk. The US raised the debt limit I think what they did was they removed a limit and didn't raise the limit. What they essentially did, by removing the limit, they made no limit.
Exactly.
Okay, so we're now up to 20.5 trillion, and because of the Trump tax reform, which, if it's executed well, will result in better tax revenues down the road, but I don't think it's going to be executed well. By executed well, I mean they take the tax break and they go expand businesses, they hire, and the incomes improve for the citizens, the population. Tax revenue improves after a year. You got to buy the plant. You got to train the people. You got to install the equipment. It's not a 2-month process. It's usually a year and a half or more. Okay, we're not doing anything. We're not reindustrializing the United States, which was a Trump campaign promise. So we're likely to do, we're likely to do exactly what happened in 2005 and 6. Repatriate money. Companies move money back from foreign locations, foreign banks, whatever, bring it back to the United States. They realize a lower tax burden, tax obligation for the United States government. And what do they do with the money? Well, back then, 12 years ago, they increased executive compensations, they increased the dividends on stocks, and they did more share buybacks for stock. And they didn't do jack shit for rebuilding their businesses, investing in their own business lines. Okay, so far, that's exactly what is happening in the early months responding to the Trump tax bill. Okay, so the public and the investment community is beginning to conclude, oh my gosh, it looks like we're going to be moving to 22 trillion pretty quick. And if you get to 22 trillion, there's a pattern, CJ. Every 8-year administration, 2-term president, first it was Clinton, then it was baby Bush, then it was Obama. Well, because of what went on with Clinton and a lot of different things regarding the tech telecom stock boom bubble, there was more tax revenue. It's a very complicated situation, but just look at the last 2 narcotics president. I'm sorry, U.S. presidents, yeah. Baby Bush and Obama. The characteristic of the narco presidency recently has been that every 8 years the debt doubles. Okay, so if Trump gets his way, wow, are we going to be moving to 40 trillion in 8 years? Well, that sounds outrageous, but 8 years, if you do 2.5 trillion a year, you get there. We're hearing now that there's going to be very likely over a $1.2 trillion deficit this coming year. Okay, so it's beginning to look to the investment community, international bond community, that the United States debt is not going to be repayable. Well, let me redefine that. The United States is not going to be able to pay its debt. The United States will therefore have to do a debt restructure at the minimum. That is a debt default. Okay. Now we're getting rumblings that a second of the 3 major debt rating agencies is considering a debt, what do you call it? Downgrade. Okay. A debt downgrade for the U.S. government debt could potentially be devastating this time around because we're looking at a rising debt yield, rising bond yield. The 10-year is moving toward 3%. Okay, the psychology is changing, CJ. It's looking like the U.S. government debt is heading toward some form of a default. You cannot say it's unpayable without saying in a second breath they're not going to be able to continue it in its present form without restructuring it. Eventually there comes a moment when it has to be restructured, when they encounter one of two kinds of problems. Auctions go completely vacant, or the derivative machinery that produces the fabricated fake bond demand breaks down. And that is where I think we're heading. Okay, let's just throw out some ratios and past history, because an important preliminary point, I'm going to get to two major types of points in ratios. The first is gold price in relation to central bank liabilities. Okay, now we keep hearing a lot of stories about the Fed, the Federal Reserve. I call it U.S. Fed because it's on U.S. soil, manages U.S. dollar, U.S. Fed. A lot of people call it Fed. I call it U.S. Fed. Forgive me, it's just my way. Okay, take a look at the Fed's liabilities. In the 1960 decade, gold backed the Fed's liabilities by only 12%. It was a great time to buy gold because gold went from 35 an ounce to a few hundred. Okay, it went up tenfold. Okay? In the 1960s, gold went up tenfold. What was the major characteristic behind the scenes? The Fed liabilities were covered by gold only at a minimal level of 12%. Okay, move forward. 1980s. The Fed's balance sheet was covered by gold by 133%. Okay, that was when Fort Knox actually had 8,500 tons of gold. It was not a good time to own gold because 1980 was a peak. That's when you saw gold go down like 50% in the course of the following decade or more. I think 1994 and 5 saw about a $400 gold price. Okay, got cut in half from a 1980 peak. The key point is that in the 80s, gold got cut in half from a peak, not an average, a peak level, when gold covered over 100% of the Fed's liabilities. Liabilities are in the form of their balance sheet holding debt securities. Okay, last year data point is now 2018. The Fed owns gold. They have 4.4 trillion in liabilities, and if you assume they have Fort Knox's 8,500 tons of gold, they cover their own liabilities of over 4 trillion by a mere 7.9%. Therefore, using the 1960 example, it's a very good time to own gold, which is set once again for a tenfold move. Why? To cover their debt liabilities. The ratio of concern is gold versus the Fed balance sheet. The Fed balance sheet is essentially a bunch of debt securities. 2 points. The Fed owns a lot of really crappy bonds called mortgage bonds and agency bonds, like Fannie Mae. The other bad point is that the Fed does not have any gold. They sold off Fort Knox in the 90s and in the early 2000s. It was the Rubin Project. It was called the gold carry trade. Rubin, being a former Goldman Sachs London office gold desk manager, was an expert in managing gold, and he set up a 0% lease rate during the Clinton administration to lease the gold, short that market, take it down, earn leverage profits, while they did the same thing on the upside to Treasury bonds, which saw a remarkable decline in their interest rate, their bond yield. So the lesson from Rubin was take the gold, have 0% off it, buy Treasury bonds, have a rally in Treasury bonds, and call it the Clinton economic miracle. Bullshit!
Yeah.
It was a gold raid and a leveraged bond carry trade. Okay, thanks to that argument to Daniel Oliver at the Mirmakin Research. The conclusion is that if we go back to a 133% coverage of their liabilities that are standing right now on the Fed balance sheet, we'll be looking at a $16,000 gold price. Okay, so that's a, I don't know exactly, 12 or 13-fold increase, but more than 10. My point is that it's at least a 10-fold rise. Okay. I could go on to other central banks, but you get the idea, because the Fed, U.S. Fed, is the most important. And I believe in my heart, following a lot of different things, hearing lots of different inside type stories, putting two and two together with very complicated pieces of the puzzle, I'm of the opinion that a growing shareholder in the Fed's financial structure behind the scenes is China. And he's cut a deal with Trump to eliminate the Fed, and I think they're going to have a bankruptcy event, while the Fed owners are going to be facing two options: fraud with prison, or whatever you do with, the extremely wealthy supranationals, strip them of their wealth, isolate them to their castles, whatever. But a good hint was the Rothschilds sold their, 13,000-acre hunting property in Austria. We're getting some hints that they're on the defensive.
Mm-hmm. Right.
Okay, so I think the other option is to the uber wealthy owners of the Fed is, if you don't want the threat of prosecution and embarrassment and publicity and maybe even revelation of your satanic ways with child sacrifices and raids on your wealth, we're just going to dissolve the Fed. And you're going to be on the hook for that $23 trillion that you borrowed at 0.5% following the Lehman event. Okay, I think they're going to allow the Fed to dissolve. That's what I think. Okay, well, that wraps up the introductory point, CJ. Next is the gold-oil ratio. We've dealt with the gold-Fed liability ratio. Next is the gold-oil ratio, which in the United States doesn't get much publicity because there's a near total preoccupation with the gold-dollar ratio. I need a...
Yeah, go ahead, Jim.
I just need a sip. That's my transition point. We need to change our focus for gold and relate it to financial structures and economies, and not just the dollar. And I've got my hands on something that Euroraj passed on, and it's not a 2018 vintage research report. It comes from a group called The Forest Through the Trees. Strange name, but they go by FFTT also. It's a January 16th research report. We talked a little bit about it before starting the recording. I just need a break from my voice, CJ, so if you could
Yeah,
I'm
absolutely.
sorry.
And I paused because I didn't want to ask too many questions because I know there's a lot to get through in terms of the opening. So it's very interesting to watch all this play out. And a lot of people had speculated that, in fact, that Trump was there for a reason, and because of the restructuring of the debt that's going to occur. Now, in terms of the private and public debt that is held, Jim, what happens to that debt?
What happened to the U.S. Treasury debt?
Correct. Yes.
Well, to begin with, let me give you a little background story. I had a lot of contact with a fellow who served as a pretty interesting source until a year ago, named Cato. We went in different directions. Cato is a former U.S. military fellow with NSA connections. And he told me 2 years ago, with stories, individual stories, that there were a number of smaller central banks dumping their treasury bonds, and they were doing so with a 35% discount on what they were given. For instance, they sold $1 billion worth of treasury bonds, and they got $650 million for it. 35% discount on their sold U.S. Treasury bonds. And I said, is this just one or two? And he said, no, it's like 10 different countries. I said, you mean like Brazil, Thailand? He said, yeah. The secondary tier nations were dumping their treasuries. And I said, well, what about the first tier? And he said, well, they're powerful enough that they can threaten the United States. So they get 100 cents on the dollar. I said, you mean like China and Germany and whoever? Saudi Arabia selling their treasuries. He said, yeah, they get 100 cents on the dollar. They use their treasuries and buy U.S. military weapons. Or they'll just trade in their treasury bonds, say, to finance the Holy Grail pipeline system for oil delivery between Russia and China. That's on 100 cents of the dollar. But the secondary nations, they're already selling at a discount. So you've got a restructuring of the U.S. Treasury bond financial system. I thought it's not a good description. The U.S. Treasury bond just system of redemption. You've got a discount there, which means it's enduring a restructure only upon redemption. Okay, so it's a restructure, but only upon redemption. If you're a secondary nation and you can't threaten, like Philippines, what are they going to do? What's Philippines going to do to threaten the United States? Say, we're not going to continue your U.S. Air Force contract with a giant air base in the Philippines? Well, they did that, and they got 2 back-to-back hurricanes, cyclones, in back-to-back months back in 2015. Okay, that's what you get if you're a secondary nation. But what did China get? Well, China got a little bit of a harp wall, so a drought hit parts of western China, and some agricultural output issues. And okay, they got the message. So, okay, we hit China, China hits us. How did China hit us? This is a very interesting, not exactly trivia. Let me put it in this form. Did China have a role in the subprime bond Lehman fiasco?
Yes.
They sold a stack of Fannie Mae mortgage bonds. They lit the fuse. Well, why would they do that? Okay, next question. That was 2007. The Chinese are on record saying, we're going to be unloading our agency mortgage bonds. We prefer to hold treasury. In other words, we're going to shit on you, Wall Street, and see how you like it. Okay, but what happened 2 years before then? Vis-a-vis United States and China. China had leased the United States in the year 2000 a warehouse full of gold in the tonnage I'm guessing about 3,000 tons. Maybe as much as 4,000 tons. Something like 3,000 to 4,000 tons of gold the Chinese leased to the United States in 2000, and by 2005 it was clear that the United States was reneging on it. This is not in the Wall Street Journal, not in the New York Times, not in Barron's. But the Chinese were angry at the United States because we did not repay their gold according to the contract. And they're not alone. Germany didn't get theirs either. Austria didn't get theirs either. Netherlands didn't get theirs either. And just to make sure that Germany got paid back, we invaded Libya and invaded Ukraine, stole 144 tons in Libya, stole 42 tons in Ukraine, 185, 190 tons. That's a good amount to start paying back Germany. And we started a war in Chad to overtake their gold mines. A lot of these foreign wars are about gold. They're not about, terrorism. They're about gold.
Interesting.
Okay, so what did China do in 2000 to protect themselves against a failure to return the gold in the big gold lease of 3,000 or 4,000 tons? They set up some derivatives with J.P. Morgan headquarters as collateral. That's how they bought J.P. Morgan's headquarters. And if you look closely at the price paid, it was something like at a 50 to 60% discount on price. So they set it up very well, intelligently. Okay, that's the background going into the Lehman event. It didn't just happen on its own. The Chinese decided, we don't like Fannie Mae and agency mortgage bonds. We're going to start selling them, and they precipitated the Lehman event, the subprime mortgage. Okay, that's kind of your, next phase introduction. I'd like to get to the Basel solution, CJ.
Yes, please, Jim.
We've now set up a situation where the economies are stuck in a recession. They can call it sluggish economy, sluggish recovery, all they want. I don't really care. What they're calling growth is price inflation, so that it doesn't show up as a minus 2 and 3 and 4% GDP every single year since Lehman. We have not gotten out of this mess. And proof in the pudding is the slowdown in the money velocity. It is nowhere near a recovery. The bankruptcies continue up. The joblessness increases. The worker participation is going down. Bankruptcies are going up. Everything is pointing in the wrong direction ever since 2008. We've never gotten out of the recession. It's a recession every single year. The only respite that we've had has been the cutting in half of the oil price, which is not a really good thing to do economically, because it happened at the same time as the lowering of the bond yields for the entire economy. And one of the interesting little facts of financial life, in the 2000 decade, in the 1990 decade, there is more interest income from bond yield payout than there is interest payment for basic things like mortgages, car loans, home improvement loans, student loans. Therefore, if you lower the interest rate, you're punishing the economy because there's more income than there are debt payments. You won't read that in the New York Times, Barron's, or Wall Street Journal because they call QE and 0% stimulus. It is the exact opposite of stimulus. 0% is a wet blanket on the economy, killing insurance companies and pension funds. which are all on the ropes right now. The QE bond monetization, unsterilized hypermonetary inflation. Unsterilized means they don't withdraw money from the banking system while they do the infusion. There's no net zero there. It's all infusion. QE is resulting in a sequence that results in capital destruction, I believe. Hedging with hard assets, and before you know it, that results in a higher cost structure, but they can't increase the prices because of the Chinese and other emerging market competition. So you end up shrinking the profit margins, and you end up having shut down businesses and business segments for larger corporations. QE kills capital, and 0% is a wet blanket on the economy. So here we are, 2 years after the oil price went down, and it's time to focus not on the gold-dollar ratio, but on the gold-oil ratio. Okay, the gold-oil ratio is something that has been rather steady over time. And when it gets out of kilter, you get a financial crisis on a wide scale, not just one or two countries. Okay, that's what we have now. You got to go back a little bit in time. When the United States and the Fed set up the petrodollar, it meant that the Arab nations, OPEC nations, originally the Arabs ran OPEC, but in time it began to include Nigeria, Angola from Africa. In time it began to include Indonesia from the Pacific Rim. In time it began to include Mexico and Venezuela from the American hemisphere. Okay. The deal. This is like a deal that not written in a contract. But when they set up the petrodollar, they basically said to the Arabs, you got to leave, you first need to take payment for oil in dollars. And you need to leave the dollars in dollar form. You need to leave your oil payments in dollar form. You cannot take your dollars and go buy euros and buy Japanese yen and buy gold and buy a bunch of property. You can't do that. The deal was the Saudis would set the rule, set the pattern, that they would leave their dollars from oil payments in treasury bonds. It was called the petro surplus recycling into dollars. And there was another side deal in there. They had to buy a lot of U.S. weapons. I think there was a third deal in there that over time the Saudis had to fund and finance and source the Exchange Stabilization Fund. Because if you look at the last 40 years of surpluses, the Tick report does not have a line item for the Saudis. And they were the biggest oil producers in the world, had huge surpluses, and I do not believe that they only accumulated $160 billion in 45 stinking years. I think it was 20 times that. I think they have $3 trillion stuck by agreement in the Exchange Stabilization Fund, which they might have agreed to put there to manage the stability of financial markets, but the United States, just like with China and all the treaties that we make on the military side, we broke the treaty, broke the agreement, and told the Saudis, F you, you're not getting your treasuries back. Okay, so that's more background. The gold-oil ratio is important because when it's stable, things hum along in both the economies and the financial structures. But the deal that the U.S. made, in addition to the petro surplus recycling, the deal was if the oil price starts to get too high, the Fed will come in and raise interest rates and slow the economies down and bring things back into kilter so that the gold-oil ratio is more reasonable. Bring it back down. Okay. Or bring it back into line. Because if gold is, back then when oil went up, so did gold. But when oil went up, it hurt economies. So the Fed's responsibility was raise interest rates. But what did Greenspan do in the 90s? He didn't raise interest rates. He introduced the derivatives, which was like a fake behind the scenes interest rate hike. It was like a kind of a slippery layer to protect against the financial system from problems, which is now erupting. Okay, so the Fed made a statement, we're not going to raise interest rates. Okay, fine. And when they didn't, we got the irrational exuberance of 96. And it continued until we had the telecom 2000 and 1999. They blamed it on the millennium. No, you blame it on the Fed for not raising interest rates after the oil price went up. So we broke the social international contract, did not raise interest rates, and financial bubbles took place. And the United States became well known as being not a manufacturing site anymore, but a financial bubble site. Fed became a feeder for serial financial bubbles. Oh my gosh. Okay. The oil producers in recent years have begun to sell off their FX reserves, selling off their sovereign bonds, principally treasury bonds, and allowing their currencies to rise. Okay, so they're suffering some price inflation because they have to sell off their FX reserves. In other words, the second-tier nations are saying, screw you to the United States, we're not regarding your treasury bonds as sacred anymore. They're having to deal with less oil income. Saudi is the best example. Their oil income is cut in half. They're what do you call it? Selling down their reserves, FX reserves they call it, sovereign bonds reserves. FX just means foreign currency reserves. I mean they could hold a bunch of euro bonds and maybe some Japanese government bonds, but they're foreign currency bonds and they're principally U.S. treasuries. So little nations are selling off their treasury bonds and FX reserves because they have less income because of the problems that a lower oil price has produced. This is not sustainable. I mean, you got some research reports that are coming out, including from the BIS, that confirm that 80% of oil reserves now are not economically viable, which means they can't be drilled to produce the oil in a profitable manner in a sustained business. This is anathema. Why did the oil price go down? Because the gold oil ratio got tinkered with by putting a ceiling on the gold price. The gold oil ratio needed to go up. And the only way it could go up was to lower the oil price, which has now caused problems. Oh my gosh. Not only that, but all the nations that have sold oil outside the dollar have been attacked by war and financial attack by sanctions. Oh boy, we have an incredible mess now that is begging for a solution. You got the Italian banking system that's on the ropes. They have bank runs. You got new forms of bonds called cocoa bonds that actually take a hit when their balance sheets get harmed, as opposed to independently floating corporate bonds for the banks. Okay, cocoa bonds are vulnerable. Corporate bonds are not as vulnerable. You got the French government bonds now that are, for a while, they were seeing their credit default swap, the insurance against default. Their insurance cost was going up, but the Euro Central Bank is stepping in and buying a lot of different member nation sovereign bonds. Their balance sheet is just as bad as the Fed. U.S. Fed has $4.4 trillion. I don't know the exact figure for the Euro Central Bank, but I think it's around $5 trillion. And it's loaded now, not by any majority sense, with corporate bonds. They're buying junk corporate bonds so that you don't have a financial event like Lehman in Europe. This is insane what's going on. Okay, next big point. I'm going to my outline of points here.
No, Jim, that's perfectly fine. Keep going.
Okay, at the bottom of the list is gold at 10,000. Okay, so it's worth following this sequence of logic.
Okay.
That's the motive for staying tuned. Okay, time for a sip of water here.
Yeah,
Give me a break.
Absolutely.
Not a big sip, just a little one. Okay, in 1999, the Hong Kong conversion to Chinese ownership changed everything. It changed everything because the Chinese, in the open, received all this different, they call it FDI, foreign direct investment, FDI, foreign direct investment. And I remember some figures floating around that just in 2001, 2, and 3, $23 billion worth of U.S. and Canadian corporate investment hit China for creating, building, and establishing their manufacturing sector. Okay, that was the visible side. I explained to you about 20 minutes ago the not so visible side. Why did China get all this generosity to build a manufacturing center in China with the benefit of lower cost for labor and a pretty well-educated workforce? Their science background is now much better than the United States. Their patents produced in Asia are outpacing the United States. The United States is slipping badly. Okay, so the visible part was construction, industrialization of China with Western investment funds, the foreign direct investment, FDI. There are a lot of statistics on FDI. It's a major statistical series. Okay, the invisible side was the gold lease. Okay, China earned the favor of Western FDI investment by virtue of their big gold lease to the United States and Wall Street banks, protected by the Internal Revenue Service macro secure stream bond collateralized by JP Morgan's headquarters. We reneged on it. China has claims for the IRS income stream, and the Vatican ownership since the Civil War has been restructured for the U.S. corporation. These are all stuff you don't read. Wall Street Journal, New York Times, or Barron's. Okay, so China earned the favor of foreign direct investment. The consequence is they became a big U.S. government creditor. I mean, at one point they owned $1.5 trillion in U.S. Treasury bonds. Now they own about a 1.0 trillion in Treasury bonds, and it's now kind of neck and neck with Japan versus China. They're pretty much the same. It's 1.0 something trillion for each. Okay? They each own so much Treasury bonds that the United States is in trouble. We can't raise interest rates, CJ.
Yeah.
Now,
go ahead. Keep going. That was one of my questions written down.
Don't worry about Japan. Japan has their ways of finagling. They just announce like infinite QE. I love that.
Yeah.
You know, September 2014, the United States borrowed without permission. Confiscate is a better word. They just confiscated $1.2 trillion worth of the Japanese government pension fund.
Wow.
Okay, like government workers in Japan. As a result, Japan was in trouble and announced that they needed to rebuild their Japanese government bonds as a foundation for their pension system, and they did it with just printed money. They announced infinite QE using the words infinite QE in October, the following month in 2014, and the result was the Japanese currency came down. Okay, those are the sort of games Japan plays to manage their currencies. The Chinese are different. They don't play the big financial games. Japan basically ruined their economy. They put their huge export trade industry on notice that it has limited time left, and they just cannot continue this game. They've had now 27 years of QE. Remember in 2012, the U.S. Fed announced QE, and they said it'd be just for 6 or 9 months. I said, no, it'll be forever, just like Japan. And of course, I was called an idiot, but here we are 6 years later, and that jackass forecast was correct. Okay,
absolutely.
So the 2000 China FDI investment / gold lease changed everything. It made the Chinese hostile because we reneged on the gold. It made China the creditor because they were running huge surpluses, like 200 billion a year. Do that for 10 years, you got 2 trillion. They're rivaling Germany as creditors on the FX parade. But it meant that the United States could not raise interest rates with any kind of a problem, like inflation. Well, we got better at lying on our consumer price index, and we went to the geometric mean instead of the arithmetic mean, and we do the substitution. And I mean, there's a blatant example in just the first couple months of this new year. The new car prices went up, but the CPI for the new car component went down. Just a basic lie. There's no substitution there, like of rickshaws for cars. No, it's just they lied about the new car prices, and they put it in as a component for the CPI. Okay, so oil must be viewed from a global balance of payment angle and not the US dollar-centric lens. The oil producers sold off their FX reserves, then depegged from the dollar, meaning they allowed their currencies to go down, and they suffered some price inflation, and they're working feverishly to reduce their imports. The United States doesn't work that way. We just import more and more and more, and then print money to cover our debt. The U.S. government response to non-dollar oil trade has been war and sanctions, and I'm very curious to see what will happen when China wins permission from the Saudis to buy their oil and pay in RMB. I prefer calling it RMB, the renminbi, rather than the Chinese yuan. Let's just call it the Chinese RMB. I think the Chinese are going to see something fierce in a series of trade war announcements. Mm-hmm. We've started to see it. A lot of talk in the Trump administration of a big tariff for foreign steel. Okay, so the Chinese deal changed everything. Now, let's get to the Basel bunch. Okay, they're the Uber bankers. They make the rules for central banks. They help central banks out when they're in trouble and they need a big loan or a big gold lease. And what I'm hearing recently is that Basel has said to London and the gold market, we're not going to lend you no more gold. We're shutting down our transfer of gold reserves to the market. The Vatican, on the other hand, has said, no, we'll keep it coming. Okay, big distinction. The Vatican's Satanists and fascists, they are not Christians. The Vatican Satanist bankers, they've got 1,000 years of Satanist history. Just do your homework, people. It's called the Illuminati. called the black nobility. They're evil. And they've got hit squads. Some of the London bankers who were thrown out of windows and murdered, they were done by the Vatican hit squads. This is not new, people. Okay, so a distinction is the Vaticans are continuing with the gold supply, but Basel has stopped. And to me, a year ago when I learned this, I concluded we're going to come up against a wall. We need to know what the Basel bunch has in mind, because they don't come out with a lot of information. But occasionally they do in the form of a quote given at a conference when they're showing off. 1981, BIS, Bank for International Settlement, Basel, Switzerland, Chairman Willie Zijlstra, Zijlstra, quote, the 1960s saw a growing disequilibrium in international payments, consequent on the deficit of the U.S. balance of payments. He's talking about the growing trade deficit for the U.S. The dollar became overvalued, and the U.S. found it increasingly difficult to meet its obligations to convert the dollar into gold. What he's saying is the situation was set up for Nixon to close the gold window. He went on. It is my firm conviction that the devaluation of the dollar, combined with a substantial increase in the gold price, as per Article 4 of the IMF, would have meant a real improvement to the situation. So, the brilliant, powerful Zijlstra offered a prescription to resolve future financial crises, founded on the gold-oil equilibrium to repair from its breakdown. In other words, he was saying, let gold go much higher, which is what happened going up to 1980 and the gold peak. So he's talking about the balance of payments going haywire in the United States, trade deficit hitting the United States. Nixon closed the gold window, and the gold price went up to 800 at the peak, just like Willie Zijlstra, chairman of the Basel BIF, described and prescribed. Whew, okay, that is your background. In 1981, okay, after Nixon closed the gold window, before you saw the come down in the gold price. Okay, he's justifying the whole process. Okay, major point. The gold oil balance has broken down due to a lower oil price after the U.S., Wall Street and London bankers obstructed a higher gold price. We've been suppressing the gold price. You have a tripling almost in the money supply in just the last 10 years since Lehman, almost a tripling, not quite, I think. And the gold price has not tripled. It should have, but it didn't. I mean, the Swiss got in the way with their 120 euro Swiss franc peg. A lot of things came into the picture. But since the U.S. Fed and London obstructed the higher gold price, the ratio went up for gold to oil by virtue of the fact of cutting oil in half. We should have had gold going up double, but we didn't. Instead, we saw oil go down double. That's how important the gold-oil ratio is. There are factors involved. There are derivatives involved. There are background cables involved that force an adjustment. So, we have a new crisis on our hands that has hit the Treasury market. The neutral solution centers upon gold for the next global standard in finance. Why is that? How many times have we heard gold doesn't pay a yield? Mm-hmm. Right. Gold is useless. It's like an uninteresting, boring, useless economic substance. And I say, well, so was lead for colonial ships, but it served as ballast very well to prevent, the ships from going down at sea during storms. Okay, I'm sorry. I need to take a quick drink here. I'm
Great.
struggling.
No. Yeah, for some reason I have it as well, but yeah, great breakdown in terms of, specifically the rates. I think the Fed is just completely head faking any type of rate increase. We heard that, 2018 is looking at least 3 or 4 rate increase. I believe that's just a complete head fake. They can't afford to raise rates, Jim. I mean, what would they can't pay down any type of debt. What would that do to even service the debt? And then just
1% would mean $205 billion more to the U.S. government borrowing costs.
Right.
But it's worse than that. I made the point. I mean, I didn't even bring up the fact that the U.S. Treasuries is $20.5 trillion, so that higher interest rate means higher borrowing costs. I'm making the point that we have foreign creditors, China, and Japan can take care of themselves with playing games in the financial structures. But my father told me once when I was a little kid, he said, Jim, the Vietnam War is a mess. We've gotten our first $1 trillion in debt. And I said, I know, Dad. I don't know how it. I don't know how we can prevent it going up. And he said, well, I don't know. Economic development, Jim, I don't know. I'm sorry.
No, that's okay. And then the administration is proposing, with their spending budget, a new revised $1.5 trillion infrastructure spending, and the Fed is willing to only cover about 25% of that and expecting the states to compensate the difference. Jim, what level of just pure stupidity?
Well, it's desperation and silly ideas being put forth. Okay. Debt saturation, I think, is going to lead to a higher gold price as a solution, because we can't raise interest rates. We play the derivative game and we got a blow up. Remember, Greenspan had a quote, we have now successfully offloaded the risk into derivatives and things are very stable.
Yeah, we've
managed. And 2 years later, Lehman erupted or was murdered, killed. The whole subprime bond situation hit. Okay, when you have debt saturation, you cannot raise interest rates. I didn't finish my father's side. My father told me, well, Jim, at least we owe the debt to ourselves. Well, something happened in around 2009 or 10. Over 50% of the floated U.S. Treasuries were in foreign hands. That was a significant turning point, right around 2010. It interestingly happened about the same time that the PIGS sovereign debt blew up. And I'm not saying it blew up as a distraction, but it was simultaneously. So the U.S. foreign holdings of Treasury debt didn't become a major story. Other stories eclipsed it. Okay, so now we've got foreigners owning our debt in a big way, and we cannot raise interest rates, or else they're going to dump their treasuries. If China's sitting on right now $1 trillion, and they're not hedging worth of treasuries, and interest rates go up, say 1.5% on the 10-year, the Chinese have protected themselves. They've gone to shorter maturities. And what they're doing is they're letting them mature, and they're getting paid, and they're not buying treasuries with the money that they're getting from the matured treasury bill of, say, 2-year duration. There was a move between QE1 and QE2. It was called Operation Twist by Bernanke. And that was to permit the Chinese from move from 10 and 30-year maturity U.S. treasuries to short term, like 5 years and under. And no one paid much attention except the smart people, which includes the editor and jackass colleagues. We reasoned the Chinese were getting ready to get out of treasuries and draw down their large $1.5 trillion worth of treasuries, and doing so by way of transferring to shorter maturities, letting them mature, and not recycling the money. Derivatives blew up, interest rates cannot go up, and And I followed the last few interest rate hikes. The first one had a reverse repo feature behind the scenes, which essentially meant to the Wall Street banks, you don't have a rate hike. The most recent rate hike had some little feature regarding Wall Street's reserves held at the central bank. Okay, so they lessened the blow. Well, if they're held at the central bank, maybe the central bank will cover the loss on those bonds from a higher yield and lower principal value. Okay, so maybe that was what was going on behind the scenes. Maybe they monetized the bond loss for Wall Street's excess reserves held at the Fed. Okay, more games. If you can't raise interest rates, you're going to get a sovereign bond problem. And we're starting to get it. The perception is, the psychology behind the treasury bonds right now is they're not going to be repayable. U.S. government debt is not going to be repayable. So what are they going to do? Well, for the last year, a new statistic has been on the scene called last 12 months average, no, sum. The last 12 months, what was the total amount of foreign dumping of U.S. treasuries? Well, it's been 300 to 400 billion pretty steadily. Okay, foreigners are dumping treasuries. Who's buying them? Because until a few months ago, interest rates are not going up. What's called the interest rate swap derivative, managed by the Department of Treasury, funded by Wall Street banks on the side. Gosh, back in the last half of 2009, Morgan Stanley put on $9 trillion worth of them. You had a movement in Treasury bond 10-year yield from 2.4 to 1.4%, a full 100 basis points drop, and U.S. government came out with a bullshit story of a giant global Treasury rally. Now, this is when foreign investors weren't doing any new buying. Mm-hmm. It was the interest rate swap derivative. And they learned from this experience that they needed to go to 0%. They needed 0% for the feeder system on the interest rate swap derivative. 0% feeder, out comes a 10-year bond demand. The predominant buyer of 10-year Treasury bonds right now is the Department of Treasury with their derivative machine. Wow.
Madness.
Okay. Now, I'd like to get to a different fellow from Basel. And his name is William White. And he has a more recent quote, like in the middle of this mess. But interestingly, right before the oil price went down, got cut in half. His quote is in 2015. I'm reading his quote. We will need another global crisis, and one whose roots can clearly be identified in the shortcomings of the current non-system for this to happen. I suspect that geopolitical issues will trump economic issues. Now, interesting he used the word Trump. Yeah, that just comes out and hits you in the face. I don't think he knew Trump was going to become president. Okay, what he's saying here is that the gold-oil ratio is a mess. We can't raise interest rates. We're stuck 3 years into QE. Hyper monetary inflation buying U.S. Treasury bond, monetizing the U.S. government debt without sterilization. We're in a mess. We can't get out of it. And he's referring to having no options and expecting some big problems to form. Like, for instance, when the U.S. government debt goes up and up and up and up, and confidence changes. He referred to geopolitical issues overriding economic ones. The geopolitical issue he's referring to is that the community of nations doesn't want the dollar to have the privilege of global currency reserve.
Bingo. Absolutely.
In other words, no more free credit card for the U.S. economy. Oh, yeah. Okay, so White expected a global crisis, a grand one, to erupt. He was describing the financial system as dangerously unstable, with a threat of an avalanche of bankruptcies. He made reference in certain commentary, which will test the social and political stability. He continued in his quote, this is rich, this is kind of a climax. The situation is worse than it was in 2007. He's referring to pre-Lehman crash. Our macroeconomic ammunition to fight downturns is essentially all used up. He's saying the Fed has no more ammunition. The Fed has no more options. He's saying the Fed cannot raise interest rates. He's saying the Fed is stuck with derivative solutions that will eventually break from too much leverage on too much volume. I call it the higher and higher Sears Tower, where they're reducing the foundation size. Okay, he goes on in his quote, "It will be obvious in the next recession that many of these debts will never be serviced or repaid." In other words, he's saying debt default and restructures coming up. He's going on. He goes on with the quote, "And this will be uncomfortable for a lot of people who think they own assets that are worth something." He's trying to say sovereign bonds are going to go worthless. He continues in the quote, "The only question is whether we are able to look reality in the eye and face what is coming in an orderly fashion, or whether it will be disorderly." It's starting to be disorderly now.
Yep.
We have bonds moving up toward 3%. I think they're going to go above. I think they're going to work like hell at the Department of Treasury with interest rate derivatives to cap it and bring it back down from 3%. And I'm real curious whether they fail or not. I think they're going to succeed initially and then later fail. That's my gut. Okay, he makes a final point, this William White. Debt jubilees have been going on for 5,000 years, as far back as the Sumerians. Okay, in the central bank vernacular, a debt jubilee is sometimes accomplished by letting the gold price go way up. Why would they do that? Okay, we all know the damage that happens from letting the oil price go down. You get, look at what's happening with the Wall Street credit portfolio for their energy sector.
Right.
It's not just the shale industry, it's the entire oil industry is causing them problems. And what gets the attention is the shale sector because it's the most recent and it has some covenants in there that are, a little bit newer style that forces liquidation and forces default and forces a lot of things, forces bankruptcies. And that's why they urge the Fed to violate their charter and start bidding on crude oil. The Fed is buying crude oil futures contracts. The Fed is buying S&P contracts, stock contracts. The Fed is violating their contract with the U.S. Congress. Okay, now it's well known that the gold sector is kind of independent from the economy. I defy any smart person to name me 5 products that use gold in our economy. That's what I mean. Blank air.
Right. Yep.
You could look, say, to internet connectors that have a gold connector that goes into your router. That's one. It's a thin layer of gold on your connectors. There's some different rings. When it comes to precious metals applications, it's platinum that picks it all up. Platinum absorbs all kinds of toxic contents, and I do not understand how a metal absorbs toxic contents. I think it's just a very unique chemical reaction that allows it to take it in because platinum is not an inert metal. Okay, so the sovereign debt problem cannot be permitted to erupt into defaults. Imagine what happens if Italian government debt, that's my first example. Italian government debt goes bust. They have auctions that fail. They have runs. Interest rate goes up. The Euro Central Bank says, we can't touch this anymore. It's gone nuclear. We're not going to put in more investment into Italian government bonds. We've already got some. We're actually selling, says Prince Draghi at the Euro CB. Okay, so you can't have that. You can't have the Fed permitting, and the Department of Treasury permitting U.S. Treasury bonds to go bust. You can't even allow them to go into serious crisis mode. You can't let, okay, I love saying this. Take a look. You got 1.2, 1.0 trillion in annual U.S. government deficits. You've got a trade deficit of now that's probably going to be on the order of $600 billion this year.
Yeah, it's going to be massive.
So on a fundamental basis, considering the low employment, I should say, the high unemployment, the poor savings rate, and the diminishing household income, diminishing household net worth, diminishing household just savings, the U.S. should have, without any tampering from a central bank, they should have an interest rate on their long bond of anywhere between 8 and 15%. You can't have that. So the central banks will not permit sovereign bond defaults. We cannot allow even the 10-year yield to zip up past 3% and march up to 4, threaten it, come back down, and then wing it up to 5 or 6%. We cannot have that happen because every central bank on the globe will be selling their treasuries because they'll be losers and worse. Very few people think about this. Since the treasury bond is something like 60 to 65% of all banking system reserves, if they start to go down in value, you're going to have entire banking systems across the globe going insolvent, and they will be dumping their treasuries to buy gold and forcing it higher. I think that's what they're going to be doing. There's no harmful economic effect to doubling, tripling, or having tenfold higher gold price. I mean $5,000, $8,000, $10,000, $13,000 gold price. But before they do it, watch the central banks start increasing their gold holdings in their reserves. Oops, that's been going on for the last year. We're already getting there. It's the Eastern banks, though, that are doing that. Holy mackerel. Now, the U.S. is going to be forced to find some gold. Now, I love telling this angle story because it's so devastating. The United States cannot go back to a gold-backed currency because if they did, the $500 or $600 billion deficit in trade would translate into 12 to 14,000 tons of gold lost in the first year.
Wow. Amazing.
So, Trump had a good campaign promise of reindustrializing the United States and having $1 trillion worth of infrastructure so that we can build tens of thousands of new businesses per year. Instead, he raised the military budget. We didn't even set the stage for going back to the gold standard. And he did have a gold advocate named, I think, Shelton or Schulten on his staff of economic advisors. And Judy Shelton, there it is. I got notes on my wall. I got a couple dozen notes on my wall. Sometimes I can't find one when I want, but I do see it. Judy Shelton, Trump Gold Advisor, Economic Staff. Okay, I think she probably has a minor role right now because Goldman Sachs doesn't want a gold advocate in the room. All right, they can't raise interest rates. They must let oil go up and gold go up faster. They must relieve the economic problem from a lower oil price. They must allow the oil producers to win a surplus because they're selling treasuries as a result of their shortages and deficits, including Saudi Arabia. The solution, according to the Basel Bunch in Switzerland, let the oil price go up, let gold go multiples higher, and let the central banks increase their gold reserves. Before this happens, they're going to let the dollar go down. They're going to abandon the dollar. And here's a key point that very few people think of, but this FFTT gang raised to my attention. There are two classes of nations out there that are very important. Creditor nations, in other words, they run surpluses and buy FX reserves, they buy treasuries, they buy UK gilts, they buy mortgage bonds, they just invest in foreign countries to help them out because they have deficits. Creditor nations that run a surplus. The other type is energy importer. They don't produce much oil. They don't produce much gas. They must import it. They like the fact that the oil price is down, but they're having bigger problems because the global economy is a mess as a result of not raising interest rates in the face of asset bubbles. The global economy is a mess because the oil price is down, even though the energy importing nations benefit from that. Okay, so the energy importing nations really don't want really cheap oil. They just want a reasonably priced oil that's stable, that they can hedge against, and they can manufacture with, use in their feeder systems, and continue to run their economies. Okay, but there are two nations that are both big creditors and energy importers, and they are Germany and China. And those two nations are going to make sure that we go back to a gold standard, and they're going to make sure that we see a $5,000 to $10,000 gold price, even if it means a higher oil price. Higher oil price is not a very big challenge to overcome. If you have a higher oil price and you can raise general prices a little bit, well, you can overcome that. If you got technological improvements like Germany does all the time, if you got low cost basis from like labor, like China does, you can overcome that. The energy importers and the creditor nations are going to tell the United States, you are neither. You're not an energy exporter, except for the absurdity of the shale sector. 2 to 3 units of energy to produce one energy. Yeah, that's a great solution in the United States. Okay, that's not going anywhere, and Wall Street's credit portfolio for the energy sector is proof of that. It's all going into the tubes. Gosh, you raise the energy, you raise the oil price, and you ruin the shale sector. I mean, there's nothing going right with the shale sector. Okay, the United States is not an effective energy exporter, and they are a gigantic debtor. So, United States, you lose the vote. The rest of the world is going to vote to let the oil price go up, to let interest rates go up, let the dollar no longer be the global currency reserve, go back to the gold standard, and let it rise 3 to 5, maybe 10 times. Basel laid out the prescription using the gold-oil ratio, talking about the problems of allowing the gold-oil ratio to rise by virtue of the fact of a lower oil price. They see a lower oil price as a disaster in the making, which is exactly what it is. And their idea of a debt jubilee is central banks load up on gold, and then it triples in price just for starters. The United States will lose the vote because we're going to lose the global currency reserve.
Wow. Jim, we also witnessed Trump, just a huge, massive increase in military spending. Just a week and a half ago, there was a Senate Intel Committee hearing where time after time again, you heard that China is the aggressor, that Russia is the aggressor. Is there anything militarily that you think that the U.S. will try to do to disrupt this change that's occurring?
Nothing short of trade war, like increasing steel tariffs and continuing with the sanctions against Russia and, violating the Iran nuclear treaty and putting sanctions back on Iran because they continue to sell oil and gas. They got gigantic gas reserves. Iran's selling energy in outside the dollar and going to barter and setting up an RMB account with China for their barter and guaranteeing it with their import-export, or what they call it, Export-Im Bank. United States is going to be found to be quite helpless. That's what I see as coming. The United States is going to be seen as not having solutions and being part of the big problem. Therefore, they're going to lose their vote.
And then you'd put some estimates in terms of gold pricing as it ramps up. What type of target price do you put around oil, Jim, in your forecast as far as that gold oil balance?
Oh, I don't know. It depends on what they do with gold. It's about the gold oil ratio. If oil continues up and gold continues capped, with a lid on it, a ceiling put on, it means the gold oil ratio is going to come down. And that's not the way to fix things. The gold oil ratio needs to go up. So I think you're going to see increased pressure on gold. I think you're going to see Eastern nations announce that they're dumping treasuries to buy gold. And the U.S. is going to have to resort reluctantly to the derivative machinery to contain the situation and produce the fake demand for treasuries. Okay, when you had a rate hike, you saw increased leverage for the Wall Street banks. They did the reverse repos. And I know this is kind of Greek to a lot of people, but the reverse repo is a sign of desperation. Reverse repo tells the banks, the Fed is telling the banks, give us your cash, we'll give you treasuries, and we'll let you run up the leverage on the treasuries 100 to 1. You can't do that with your cash, but you can with your treasuries. So, the Wall Street banks reduce their cash, which increases their dangerous ratios. They increase their leverage, which is, again, another dangerous type of ratio. And the banks are more vulnerable to high winds. I love making the Sears Tower example for derivatives because they're very hard to wrap your head around. The volume of the Treasury debt is going up due to the fact that the government debt is rising over 20 trillion at a clip of $1 trillion a year, maybe more. Okay, so the Sears Tower is getting higher. Okay? But due to reverse repos and the solutions set out by the Fed to take their cash, give them treasuries, allow them to do more leverage, what that means is the Sears Tower has its foundation lobby less wide and less long. It's a smaller footprint for the Sears Tower. Now, what happens to a building if you have two buildings side by side? One has a large foundation and it's 100 stories high. The other has a 1/3 smaller foundation footprint, but it's 150 stories high. What happens in high winds? The higher building with a smaller footprint is at greater risk. What are the high winds? Financial market turmoil, which we have now. So the solution that the Fed forced the Wall Street banks into by virtue of the reverse repo left the Wall Street banks more vulnerable to the conditions precisely what we're seeing now.
Jim.
This is not going to end well. It's going to erupt. I'm expecting, as I said before, we're going to see the long-term treasuries, the 10-year, TNX is its initials, TNX, 10-year yield, I think it's going to go above 3%. I think they're going to bring it back down, but I think there's going to be a firestorm to sell it again and to go above 3%, cause bigger problems like 20 and 30% stock market declines. And then the headlines are going to be, when will this stop, rather than buy the dip.
Right.
The dip is the dipshits doing the buying.
Mm-hmm. Putting the money
This
back
is
into
not
it.
going to end with successful capping of the 10-year yield. I just cannot see that happening. I think the machinery for the derivatives run by the Department of Treasury, which is basically Goldman Sachs and JP Morgan, I think the derivative machinery is going to come under great strain and begin to break down and show signs in ways that are very difficult to foresee. I don't know. We have one little side indicator right now. The interbank lending is just completely going away. It's just huge declines in interbank lending.
Mm-hmm.
Okay, little things like that. Okay. I don't know what's next, CJ. I just know something ugly this way comes.
Yep, absolutely. Absolutely.
But I laid out the various factors with a preliminary on gold versus central bank liabilities, and then the whole issue of gold-oil ratio and energy importers, and how the U.S. cannot raise interest rates, and how the creditors are getting out of treasuries now, and how the dependence is on the derivatives. I think the dependence is going to be so overwhelming on the derivatives that they begin to break down. And I don't think it's a quick event. I think it's going to be like a 5-stage event over the next several months, maybe a year and a half. We don't know how these black boxes work, but we do know they require 0% for the feeder system. And that is being removed. I think the masters behind the interest rate swap derivative machinery are saying, we've got some new whiz-bang devices to handle higher interest rate on the feeder income side, the feeder system, the short term, the 3-month treasury bill. We can handle that. We have some new whiz-bang features, but I don't think they've been adequately stress tested. I think they're going to break after a couple months on the job. This is going to be a very exciting time for the global financial industry.
Jim, thank you so much for spending your afternoon with us today. Any closing thoughts? And then obviously, please share how our listeners can learn more about your work.
Closing thoughts. I gotta say this. People are being lured into the stock market. They're being lured into buying the dip. They're being lured into Bitcoins. I had a client cancel out of the hat-trick letter a month ago and said, I'm sorry, I'm moving into Bitcoin. I'm going full boat. And I said, well, why don't you come back after you take a 40 to 50 to 60% loss? People are leaving the best investment, gold and silver. I asked the Voice a couple of years ago, I said to him, you know, sir, I have been advising people to do precious metals investments, and I've been telling them 70 to 80% minimum silver, the rest gold. No other precious metal. I don't think platinum is the solution. I think silver is the best solution. I said, sir, what is your recommendation to your billionaire clients? And he said, 90% silver, 10% gold. Sit back, get out of debt, because whatever debt you're in is going to cause a problem. What will force the reset, he said, will be global debt problems as a result of saturation and sovereign debt defaults and restructures. The best investments are gold and silver. I think silver is better. I think it's much better. Whatever gain gold has, silver will have double to triple the gain. Like if silver, if gold goes up 50%, silver is going to triple. Gold goes up, double, silver is going to go up fourfold. And that's not saying a lot. That's only saying $70. $70 for silver will not break the silver component market. Like a typical product might have, 3% of its cost being silver. Well, if silver triples in price, it's now 9. Big deal. They raise the price a little bit, cover the big increase in the silver cost. It's a minor silver component. So therefore, a minor silver component impact for a higher price. I'm hearing that a slew of new next generation energy systems are coming on, and just about every one of them has silver at its core. I don't want to go into much detail of that. I'm out of time. I'm out of voice. We have unresolvable problems, CJ, and we've tried a lot of bad solutions like QE and 0%. We've tried a lot other bad solutions like lowering the oil price. Now we're going to go to the real solution. The dollar loses its global currency reserve status, has to print a new and launch a new dollar. The U.S. risks third world if they cannot reindustrialize and find 10 to 15,000 tons of gold. And we go back globally on the gold standard. The U.S. must both reindustrialize and find 10,000 tons of gold. Without industrializing, they're going to lose more than 10,000 tons of gold in 1 year. And if you think that their strategic oil reserves are going to save the day, you're just dead wrong, because you need 70 of them to cover 1 year of the trade deficit. Trade deficit is worth 70 oil reserves or 13,000 tons of gold. We need to reindustrialize the United States. This entire Rockefeller plan was sabotaged in the 80s to move industry and outsource it for cheaper labor. We lost our legitimate income, which is a point I've been making to all my friends for over 25 years. What's the United States going to use for legitimate income? And I had a few smart guys give me a dumbass answer of, well, we're going to have financial engineering and rising stock values. I said, yeah, in a housing market, a sequence of bubbles and busts. Right. Okay, these are smart people with bad economic viewpoints. And that is not new in the United States. I've had three debates with Ivy League PhD economists, and I deemed them all to be well-spoken, well-heeled, and dumb as shit. Dumb as shit. Ivy League PhD economists who don't understand what money is, don't understand the impact of rising debt, don't anticipate problems with rising U.S. government debt, don't see problems with outsourcing industry, don't see problems with big gaping trade deficits, don't even recognize the interest rate derivatives that are being used to hold things together. These are Ivy League PhD economists, dumb shits. Okay, the solution is gold and silver. Sit back, get out of debt, sell your stocks and bonds, buy gold and silver, overweight silver, sit back and watch the fireworks. I hope people go to www.goldenjackass.com because every month I lay out some pretty interesting stories, information, linking things together, backing up my forecasts, demonstrating how other forecasts in the past have not worked out well. And a lot of these Mickey Mouse solutions have just caused bigger problems. I've been laying out the Eurasian trade zone in its opposition to the dollar and all the non-dollar platforms. I mean, even the British joined the Asian Infrastructure Investment Bank, AIIB, and really pissed off the Obama administration. But, you know, there was never any real economic or financial savvy in the Obama administration. There was mostly savvy in narcotics.
All right.
GoldenJackass.com. Check it out. A lot of free material, a lot of links on other public interviews, links to recent articles, public articles. Go in there, bounce around, learn some things, you know, refresh some things if you're a good student in this area already, but sign up for the newsletter. I love mentioning my two favorite compliments. One goes like this. I got one of these a couple of weeks ago. I backed out of the newsletter after 3 or 4 years, but I returned because I realized what I missed. And the other one was, I just took your free material with articles and interviews and figured that was enough, but I just got so curious because I know a person or two who signed up for your newsletter, and I signed up and I'm realizing, oh gosh, I wish I'd signed up 2 years ago. There's so much more in your newsletter from what you amply provide in your interviews, and you tie things together. I got a background in marketing research. I don't think many gold analysts do. If you put 15 things on the table, it's not a simple process to determine which 5 things of those 15 are really important and how they tie together. That's what marketing research experts do. And I certainly had an interesting time early in my career. It's funny just to call it career. I think of it, well, when I had previous jobs, you know, a very interesting job, marketing research at Digital Equipment Corporation. And one of the very few surviving areas of that company when it got into big trouble was the marketing research area and the areas that were our biggest clients. And our areas with the biggest clients ended up being the parts that got bought out. First by Compaq, then Hewlett-Packard. But then, you know, more forecast analysis and research stuff with Staples headquarters. I thought when I started that job, CJ, oh, this is going to be boring, golly, but, you know, it's a paycheck. And they offered me a good raise over what I was making as a marketing research analyst at Digital Equipment Corp. And I figured, well, you know, can't argue that. They got 270 stores at Staples, and they're offering me a nice, hefty stock option package. I'm at the first level of management, even though I'm just a high-ranking analyst. It can't go bad. Well, 4 years later, they were at 1,100 stores. I cashed in on 6-figure stock options and had a great old time and got a lot of good experience working in sales analysis and forecasting with side projects, very lucrative side projects that, you know, worked on elasticity issues and, you know, things like that. Got lots of stories from my Staples years. So got a nice, interesting career. I've hit 3 important areas, CJ: quality control, marketing research, and sales forecasting. Those are 3 major areas of statistics in the professional world. And I hit all 3 and did so running with a lot of really good results. I'm happy about my background in those 3 areas, and it's really helped me. You know, I can dissect the bullshit that we see on on, say, the jobs report. It's so simple to dissect that. You just look at the participation rate. The rest is nonsense.
Mm-hmm. Right.
Okay. Well, I could ramble on it.
No, you're fine, Jim. And
we've been at it for an hour and 40. So let's.
Yeah, it's been a lot of fun. It's been a lot of fun. We appreciate you at Rogue Money. I know our listeners do as well. Your massive reach, all the wonderful interviews that you participate in. So we truly appreciate your work, the research that you do. Again, want to thank you for being on Rogue Money Radio today, Jim.
Well, it's a pleasure being on, and this is actually the first time I've tried to explain these complex issues of gold versus central bank liabilities and gold-oil ratio with all the different collateral factors at work, explaining the Basel solution. Usually, Basel gets its way. So I think they're going to demote the United States, let it endure its problems, feed off its bones, and let the gold price move to 5 or 10,000. That's what I think.
All right. And you heard it first here on Rogue Money Radio, everyone. So thank everyone for listening in. Please make sure before you exit, make sure to hit the like button, make sure to subscribe, make sure to share this interview, and then also visit us at roguemoney.net. Visit goldenjackass.com to subscribe to the Hat Trick Letter. Jim, Willie, thank you so much for being with us today.
Oh, it's a pleasure. An absolute pleasure being on. I'm glad it went well, and I didn't know how some of these complex points were going to be explained well, but fortunately, when I wrote this February Hat Trick Letter report, I made the first sentence in bold to give away the main point, the main factor toward a very elevated gold price, and had a sequence of short paragraphs. So sign up for the newsletter and catch a glimpse of this, because it's very powerful and very convincing in an environment that no longer has potential solutions except a higher gold price.
Very good. All right, this is CJ, everyone, with Jim, Willie, and we're over and out. Take care, everyone.